Good morning, and thank you for dialing into our webinar. This is the fifth in a monthly series of free interactive webinars where we provide our view on the key tax and VAT updates across the GCC. This webinar supplements our weekly tax flash emails, which we send out every Thursday afternoon. So if you don't receive those and you would like to, please get in touch with us and we can add you to the mailing list. The aim of this webinar is to give you a snapshot of what we see as the significant issues and announcements in the GCC, rather than provide any detailed or tedious technical analysis. So it's a high-level snapshot of what's happening in the market. Your presenters today are myself, Mark Gamble. I head the tax practice in Bahrain at Keypoint, and I'll be joined by Dinesh Ravi, a manager in our tax team. We'll be assisted by a couple of panelists taking your questions: Adil Fauzi, a manager in our tax team, and Tariq Haq, a manager in our VAT team. We want these tax matters webinars to be as interactive as possible. So that means having a discussion rather than just us lecturing at you. So please, if you have questions, please ask them. There's a Q&A widget on your screen. It's either at the top or the bottom of your screen. Feel free to ask any questions you have throughout the session, and we'll try to answer as we go, but we do have time at the end to cover the questions. If for whatever reason we don't have time to cover your question, we will respond via email anyway, as well as answering all the other questions via email as well. So you'll get a copy of those along with the slides sometime tomorrow. So with that, let's get started on today's content. And we'll start first with Oman. So the big news in Oman is obviously VAT. So the VAT implementation date has now been, it'll be the 16th of April 2021. The mandatory registration threshold will be 38,500 Omani Riyals. So a similar threshold to the other GCC countries that have introduced VAT. It will be a staggered registration process. So taxpayers with over 1 million Omani Riyals of annual supplies are required to register first. So their registration date will be the 16th of April, but they must apply for registration by the 15th of March. Registration opens on the 1st of February, so just under a month or so to get in order. Registration's all done online through the tax authority's website, but you must apply by that deadline of 15th of March if your sales are above 1 mil. Then it'll have a staggered process similar to the other jurisdictions that have implemented VAT. So from 500,000 up to the mil, then down to the final tranche of those who have more than 38,500 having to register by the 1st of April of next year. So there will be a year-long staggered period. It is possible to register voluntarily for Omani VAT, but that's only available for residents. And the registration will open from the 1st of February of this year for voluntary registrants. Interestingly, when calculating the threshold for voluntary registration, the threshold is 19,250, but you can take into account either the revenue that you make or the expenses that you have. So if you've got a lot of expenses and you want to recover some of that, you can still register. Non-residents, similar rules as to what's in Saudi and Bahrain and UAE. You can non-residents must register from the first date that they make a supply in Oman for which they are required to account for the VAT. So if you have a non-resident making a supply to a VAT registered customer, the VAT registered customer will be required to account for the VAT, so that non-resident will not have a registration obligation. The list of zero-rated food items has also been released. So it covers the usual kinds of foods you would expect to be zero-rated. So fish, meat, poultry, dairy products, eggs, fruits, vegetables, baby food, bread, bottled drinking water, and salt are some examples. We're still waiting for the executive regulations to be released for the Oman VAT law, but we do expect that this is to be released pretty soon, just given the activity of the tax authority over the last week or so. I really expect it to be released soon, and also the fact that registration opens from the 1st of next month. An English version of the VAT law is available on the tax authority's website. So if you have operations in Oman, I think it's definitely time to start looking at whether you have a registration obligation and trying to work out which of these staggered thresholds that you fall into. So that's it for Oman. We'll move now to Saudi, and it's been fairly quiet in Saudi Arabia in the past month for tax and VAT. So we don't have any significant updates. Instead, we have a few interesting case studies that Dinesh will walk you through. But before I hand over to Dinesh, just a quick update on the real estate transfer tax, so the RETT. The Gazette were taking submissions on the RETT until the 25th of December of last year. So I expect that they'll release some guidance in the coming weeks, coming months around the RETT, because the law as it currently is drafted is vague in parts, so we need some clarity, and I expect that to come through. I'll hand over to Dinesh now to speak about the tax return.
Thank you, Mark, and good morning, everyone, for dialing into our Tax Matters webinar. As Mark mentioned, there has been no significant tax update last month, but increasingly some of our clients are asking us to share key points to remember while preparing the information for annual tax return. So we take this opportunity to explain some important points to be considered while preparing your tax return, as these points will help the companies to avoid query or minimize the risk of tax assessment with a significant liability from the Gazette. So let's get started with the key points. First, you can see the transfer pricing form and affidavit. As everybody knows, with the introduction of transfer pricing back in 2018, the 100% foreign-owned companies or mixed shareholder companies in KSA is required to submit the transfer pricing disclosure form along with their affidavit as a part of their return. Affidavit should be signed by the SUGBA licensed accountant. The transfer pricing disclosure form usually contains the transaction with your related party, value of the transaction, nature of the transaction, and more importantly, specifying the TP method used to determine this transaction. Generally, there is no threshold of the value of the transactions. Even if company have a single real transaction with a related party, that needs to be disclosed and get certified by the SUGBA licensed accountant and should be submitted along with the return. If there is no transaction with the related party, of course, then that TP disclosure form will not be applicable for those clients. Then moving on to the next point, salaries. This is a big problem with recently with the tax authorities keeping more attention on this salaries. Generally, the salaries in the tax return should include basic salaries and housing allowance. It is to be noted that other employee benefits like overtime, incentives, or any other benefits that should not be included under the direct wages category. As I mentioned earlier, the direct wages should include only your basic salaries and housing allowances of the employee. This salaries reported in the tax return will be compared with the GOSI certificate salaries. So generally, company needs to prepare this reconciliation and keep it ready whenever Gazette requests for it. The general reason for difference for this salary variance is basically there may be cases like increase in salaries happened during the year, which was not reported into the GOSI system, or other differences. Some of the related party employee may work for the other companies and their salary is paid by the existing company, which will not be part of the GOSI certificate of the respective company. So these are all the general variants or differences that we look into the salaries reported between the tax return and the salaries appearing in the GOSI certificate. Next point, import purchases. This is very important point, and you can see from the past, like this is a common query or the assessment that tax authority is keenly looking into and issuing the assessment. So the general difference here in the import purchases is basically the import purchases reported in the tax return. Gazette will try to match this import purchases with the custom bayan or custom report. Logically speaking, these differences would not match each other. The general differences, why it will not match, because there will be a timing difference in booking the import purchases in the books and the time that import purchases arrives in the custom. And there are other differences where the import purchases are cleared under the CR of related party or the clearing companies. So these are all the common reconciling item, but company should work on this reconciliation at the time of preparing the income tax return and should keep this reconciliation ready when the tax authority requests for it. Because usually it's a time consuming process. So if you wait till the tax authority comes and requests for it, then there will not be sufficient time for the companies to work on it. So it's always better to simultaneously work on your import purchase reconciliation and keep it ready and can be submitted whenever requested by the Gazette. And moving on to the next point, as everybody know, GOSI department has stopped issuing the hard copy of the GOSI certificate. So now company is required to take the screenshot of their GOSI report from the GOSI portal. It should be taken on monthly report screenshot. These figures will be compared with the GOSI charges reported in the tax return and GOSI charges in the GOSI certificate. Generally, for Saudi, the GOSI charges will be 12%, and for the expats, it will be 2% on their salary. Whatever the difference between the GOSI charge in the tax return, whatever the GOSI needs to be charged as per the GOSI certificate, the excess amount will be disallowed for tax purposes. So business needs to be careful here while allocating the GOSI charges based on your TB. You need to make sure the Saudi portion and non-Saudi portion of employees' GOSI charges is reported correctly on the tax return to avoid any disallowances. And at the same time, you can prepare the reconciliation for the GOSI differences, as I explained earlier. The other important points, as you all know, like the tax return has like more than 20 schedules to be reported along with the tax return. These schedules have various details to be filled in. And it is important for the business to fill all these details while submitting the tax return. Because there is a provision in the tax law, if there is any mandatory information has not been filled, tax authority have a rights to reject the return and apply delay penalties for incomplete return. So it is important to gather all the information and submit all the information while submitting your return. In case of individual Saudi service provider, they may not be having CR. So in that case, you can use their national ID and the address to fill the required details in the schedules. Next point, this is also to be submitted along with the return, the annual withholding tax return. Gazette usually try to reconcile the figures reported in the annual tax return with the tax return schedules. As you know, like in each of the tax return schedules, you will report the local and non-resident parties and different types of services. So these figures, the Gazette will try to reconcile in the annual withholding tax return. And if there is any variance, then query will be raised. So before well in advance, company can prepare this reconciliation between the figures reported in the tax return with the annual withholding tax return to make sure that the query, whenever the tax authority raises the query, it can be answered within a timeline. And last but not least, the most important point, Gazette have access to the MOCI portal, that is Kavayam, and if financial is not get uploaded, the Zakat certificate will not be issued for the taxpayer. So it is important, like while at the time of submission of the tax return, it is important to make sure that company is complying with this provision in order to get the zakat certificate at the earliest. Can move on to the next slide. Yeah. In this slide, we can talk about the live withholding cases that we have come across in our client. And we wanted to share these cases with our audience or participants to make sure like there are certain risks that business can able to minimize by taking consideration of this case study. Here in this slide, we can see first case, the taxpayer made payments to non-resident entities for advertisement cost, which includes printing, purchase of materials, and design services. So when the non-resident issues the invoice, what happened? The non-resident issues the invoice with the full value and not bifurcating or splitting the amount for each of the services. So here, Gazette can take an aggressive position and impose withholding tax on the entire amount. In this case, design services is subject to 5% withholding. So purchase of materials and printing will not be subject to withholding. Since the split up of amount is not given in the invoice, tax authority has taken the aggressive position by subjecting the entire amount to withholding. So here the key point to be noted is whenever you obtain any different services from your non-resident, you always ask the non-resident to split up the cost according to each of the invoice, each of the services. For example, in some cases, some services may get subject to 15% withholding, some services may be 5% withholding, and some services may not be subject to withholding. So if you're not splitting up your cost according to the nature of service, then Gazette will always take the higher rate of withholding tax and apply the withholding tax on the entire amount. So this is to be noted for all the business. And then for the second case, here is a live example that we have come across recently. The taxpayer is engaged in importing softwares and selling the softwares locally. Gazette took a position here and subjected this transaction as a royalty and subjected to 15% withholding. But the taxpayer is not using this license for their own purpose. They are only engaged in importing this software and selling it locally. So here the taxpayer has to make sure and maintain all the solid documentation to support the case that this software is not being used by the business, it's being only for selling purposes. With the adequate supporting documentation, then taxpayer can able to justify and win this case. So here the more important in both the cases, it's about the supporting documents that you maintain to justify your stance against the tax authority. And then from this, I would like to give another example for in related to case one. Even for technical services, this is very commonly occurring in most of the business in KSA. The non-resident entities, employees come here and deliver technical services or any other services in KSA. Usually the hotel charges and other reimbursement of air ticket will be clubbed along with the service. Here in this case, the taxi or hotel charges should not be subject to withholding if it's paid locally. So whenever you incur in this kind of cost, you can go back to your non-resident entity and ask them to provide those backup supporting documents so that the entire amount will not be subjected to withholding tax. I'm done with this. Then I'm going to pass it to Mark to take on the other thing. Thank you.
Thanks, Dinesh. So moving now to UAE. The FTA has released a public clarification on the VAT treatment of certain personal protective equipment. So the supply and import of certain types of PPE used for the protection from COVID-19 will be zero rated for VAT until the 28th of February 2021. The types of PPE covered by this concession include the usual types of things: medical face masks, surgical gloves, chemical disinfectants, and things like that. So a supply of these or an import of these between the period 1 September 2020 to 28th of February 2021 should be subject to VAT at 0%. So what happens if you've sold PPE at the standard rate before the clarification came out? So where a supplier has sold qualifying PPE at 5% and is aware of the customer's identity, the supplier can issue a credit note to refund the VAT amount paid. If the supplier is not aware or can't identify the customer, so it was like a cash sale or a walk-in customer, then the supplier must account for the VAT that they've charged. So there's no way to refund that. But that's available until the 28th of February of this year. Just quickly on economic substance. So the Ministry of Finance portal for economic substance reporting is live. The lodgement date was originally the 31st of December. This has been extended to the 31st of January. So if you haven't already submitted your economic substance notification and or report, you should do so by the end of this month. Looking now at Bahrain, on the 31st of December, the MBR released a public clarification which was specific for the telecommunications sector. And it's worth looking at because it's quite a big change for the sector and has clarified the place of supply rules for telecommunication services will now operate as follows. And it has two limbs. So for telecommunication services that require the customer to be physically present at a specific location to use the service, then the place of supply will be that specific location. So these are telecommunication services that require the customer to be physically present. So an internet cafe would be an example, as well as a Wi-Fi hotspot, because you physically need to be at a place to enjoy that service. So this rule was already provided for under the law, so it hasn't really changed. But the important point is the second limb, which says for any other types of telecommunication services, the place of use and enjoyment is the place of residence of the customer. So it's now important to determine the type of telecommunication service you're offering. If it's one where the customer needs to be physically present, then that's the place of supply. If it's any other type of telecommunication service, then we need to work out where our customer is resident. These rules take effect on the 1st of February of 2021. Determining the place of residence for the customer will be particularly important now to establish the VAT treatment. So you'll need to look at things like country SIM code, IP address, bank account location, and other factors like that. The clarification sets out a detailed list. Some specific changes to specific transactions include, so charges from Bahrain telcos to non-resident telcos under roaming arrangements, they will now be outside the scope of that. Non-resident telcos supplying services to Bahraini telcos will, under international roaming arrangements or any form of charge, it'll fall on the Bahraini telco to account for that under the reverse charge. Non-residents supplying services to non-Bahraini resident customers visiting Bahrain will not have an obligation to register for that. And finally, for Bahrain customers who are roaming internationally using their Bahraini SIM, they will be charged 5% VAT, even if you're using a service somewhere outside of Bahrain, because you're a resident in Bahrain. So that's the updates from Bahrain VAT. Given that there wasn't a lot to talk about, I thought I'd spend some time just briefly covering the partial exemption rules in Bahrain. This is because many taxpayers would probably be processing their annual wash-up calculation in the December VAT return due this month, but you obviously have until next month as well to do it. So partial exemption is relevant for those taxpayers that make taxable supplies and exempt supplies. So you're a mixed supplier for VAT purposes. For these businesses, it's expected that some expenses cannot be directly attributed to either the taxable supplies or to the exempt supplies that you make. So we call these expenses residual expenses. Generally, they're overhead costs and other costs that can't be directly attributed to a specific supply. To determine the amount of input VAT which can be recovered on these residual expenses, you need to do an apportionment exercise. The apportionment is calculated based on a formula that essentially divides all taxable supplies by all supplies, so taxable plus exempt. The formula is written on the screen, with the resulting percentage being applied against your residual expenses to determine how much input VAT you can recover. So you're required to do this apportionment exercise every VAT return, and then every year you use your actual figures and you do the exercise again, and then you compare how much input VAT you've been recovering on the residual expenses throughout the year versus how much your annual adjustment should be based on your actuals for the year. So to the extent that the annual apportionment calculation says that you can recover more input VAT over the year, then you recover more. Sometimes the apportionment percentage will go the other way and you have overclaimed input VAT throughout the year, and therefore you need to pay back the input VAT to the tax authority. So it's just an exercise that you do at the end of the year to make sure that what you've recovered is correct in line with what your sales have actually been for the year. It's more just to balance out the year's worth of input tax. So this needs to be done in either the last return of the calendar year or the first return of the next calendar year. So many of our clients are processing this adjustment in this return, the one due at the end of this month. And I just wanted to flag it now because the calculation, it can be a little bit tricky given that you include certain types of supplies and you exclude others. So it's worth looking into, as well as just making sure that you then apply the correct uplift amount to the year's worth of input tax. So it does require you to have the data from the entire year's VAT returns ready to be applied against the new formula. So I just wanted to flag that. Looking finally at the other GCC countries, Kuwait and Qatar, there's nothing new to report on tax in either, or VAT in either of these jurisdictions. Qatar seems to be picking things up a bit on the tax front, and the tax authority is starting to become more publicizing more updates and things like that. So there's a general feeling that they're starting to move a lot more, and perhaps could be the next jurisdiction to introduce VAT. So I expect to see something there in the coming months. That's the end of our content section of the webinar. We're obviously a little bit earlier this one, given that there just hasn't been that many updates in the past month, but we do have time for questions and I will start working through them. So the first one, do all businesses in Oman need to register for VAT now? So Omani residents should all assess whether they have a registration requirement. As we went through in the slides, there is a staggered registration. So if your annual supplies are above 1 million Omani Riyals, then you should be registering first in the staggered registration. And then it progressively falls away based on the annual supplies. So not all businesses will need to register straight away, but only the larger ones will need to register. There is that voluntary registration ability. So if you are incurring input VAT that you want to recover, that might be something to look at. Can RETT be recovered from the VAT return? So RETT is the Saudi Arabian real estate transfer tax, and it's separate from a VAT. It's a different tax system altogether. So no, it can't be recovered on the VAT return. You keep it separate. So it's one of those things that I think a lot of people are getting confused with, because initially you had VAT payable on transfers of real estate, but now that will be treated as exempt from VAT, and the taxing of transfers of real estate will take place through the RETT. And one of the key things about the RETT is that the recipient can't recover the the RETT. So it's separate from the VAT and should be viewed separately. I'm just looking through to see if we've got a question on corporate tax for Dinesh, but I can't see any corporate tax ones at the moment.
There are a few questions that come across, Mark. I would like to share those questions.
Yes, yeah.
There's one question. Now there is any penalty for late filing of Zakat return? So the answer is there is no late filing for Zakat return, but as per the draft new Zakat regulation that was issued last year, there is a clause for delay penalty, but we don't see this get published or become effective. But even though there is no delay penalty, but there are other statutory compliance, Gazette can issue a deemed assessment if the Zakat return is not filed within a statutory time period. So it's not only about the delay penalty. Company needs to mandatorily stick to the compliance obligation in order to not to get exposed for a deemed assessment. There is another question related to TP. Is the TP disclosure form and affidavit applicable for all taxpayers? What happens if we don't file the disclosure form and affidavit? As I mentioned earlier, the 100% foreign-owned company or mixed shareholding company in KSA is required to submit the TP disclosure form along with the affidavit. Where in case if company did not file the TP disclosure form and affidavit, then return will be considered as incomplete and then will be subject to delay penalties. So company needs to follow this obligation. There's one more question on the withholding tax side. If Gazette subjected design services to withholding tax, how can we support our view that it is for materials? So as I mentioned in our earlier slide, like if the service includes material also, it's always better to go back to the non-resident entity to split the cost for the service separately and material separately. So in that case, it's very clearly like the service portion will get subject to withholding tax at the respective rate and material should not be subject to withholding tax. Where in case both the costs are clubbed together and there is no bifurcation for the services, then Gazette will go and subject the entire amount to the withholding tax. So business needs to have this segregation between the services.
Right. There's a couple of questions on partial exemption. So is partial exemption on Bahrain input VAT applying for year 2020? And in that case, whether we need to file a revised return for the earlier periods. So yes, you'll need to look at partial exemption in Bahrain VAT for the year 2020. Each lodgement of the VAT return that you make, you should be assessing your partial exemption. So if you're making exempt supplies in, say, the February VAT return, you'll need to assess whether you need to restrict on the residual cost for the February VAT return. In saying that, this is obviously, you can now do the annual adjustment in the December return. So you'll need to consider the impact of the annual adjustment based on all your sales made throughout 2020. You do that in the December return, or you could do it in the first return of 2021. Okay. I saw there was a question on TP local files. So Dinesh, I don't know if you want to read that one out. So when do we need to file local and master file for TP to Gazette?
So for TP local file, there is no compliance or statutory timeline to file the local file. It is upon request of the tax authority to submit the local file. But company needs to maintain TP local file for every tax year. And whenever tax authority requests, usually they give a deadline of 30 days to submit your local file, which needs to be submitted within 30 days. And for master file, it's need not to be maintained at the KSA level. It should be maintained at the parent level, which usually will not be requested by the tax authority here in KSA. It's all about TP local file and about the local business transaction. Everything will be included in TP local file. So business needs to keep that ready.
Thank you. Question on Oman VAT. Any inside information about free zones in Oman? Will there be designated zones similar to UAE? as it will impact the calculation of taxable turnover for VAT registration. So at the moment, we are waiting for the executive regulations. They will cover all the rules in relation to the economic zones or the free zones that are in Oman. The VAT law itself does have reference to special economic zones, and it basically says that the same treatment for customs suspension zones will apply, but it's in accordance with the regulations, which we're waiting to receive. So there will be some special rules for them, but we haven't really got them yet. What is the process to appeal a penalty in Bahrain? So if you've been hit with a VAT penalty, there's a few different steps to take with the MBR. So firstly, if you've received a penalty, you should write first to the MBR, which is they're called the review and appeal section within the MBR. You don't have to pay the penalty at that point. You can just appeal, and that's an internal review by the MBR. They can take up to 6 months really to get back to you, and then they will issue a formal decision on the appeal. And it's with that formal decision that you then take to appeal to the VAT Appeals Review Committee, which is a separate body to the MBR. You do have to pay the fine or the penalty before you can appeal, and there is a fee that you pay to the VAT Appeals Review Committee, but the fee hasn't yet been set, but there will be a fee. And then that's a separate body. Everything's done in Arabic, and you need to make written and verbal submissions in order to get your penalty waived. So it's quite a process. It could take a while, to be honest, take maybe up to a year. So be prepared for that. Whether there's any basic food item list for Oman VAT released, is it similar to Bahrain? Yes, there is a list. So a list was released this week. I will circulate our tax flash this week. We'll have a link to the list. It's in Arabic, but I'll include it in the list in the tax flash for this week. There was it's available on the tax authority's website in Oman as well. And yes, it is similar to Bahrain. Same kind of items included. Capital asset adjustments. So I'll speak now for Bahrain. If you have purchased a capital asset in 2019, then this will be the first adjustment period for capital asset adjustments. So capital assets depends on whether you've bought immovable property or movable tangible property, as to whether you need to review the asset's use for a period of 5 years or 10 years. So if capital asset adjustments are completely foreign concepts to you, then you should look into it, because it applies throughout the GCC VAT systems, and you need to adjust the input tax you claimed on a capital asset purchase, and you need to adjust it every year based on usage. So it's something to look into. E-invoicing, for those operating in Saudi, the e-invoicing regulations will be effective from the 4th of December of this year. So you have essentially a full year to get ready. An e-invoice is basically just an electronic invoice that you can't change or tamper with after it's been issued. So it's normally issued by an ERP system or an accounting system. These will be mandatory from the 4th of December this year in Saudi. So at the moment, there's not a great deal of guidance on e-invoicing or what software meets the standards required by Gazette, but we'll see some more guidance in the coming months, I'm sure. And then you can test to see whether you already have the systems in place or whether you need to purchase software in order to comply with e-invoicing requirements. But that's for Saudi Arabia. And then we've got one last question. If anyone has any questions, we've still got a few more minutes, so feel free to write them in the Q&A and we will answer them. But there's one more question that we can cover. What will be the VAT treatment of transactions in relation to goods between branch of foreign entities and head offices. So say, for example, if the branch was in Bahrain, but the head office was in Saudi. So from that perspective, branches are considered to be the same legal entity as their head office. So transfers between the single legal entity will be out of scope for VAT because you're not making a supply for VAT purposes. So there will be no VAT consequences, but there might be, if you're moving goods between jurisdictions, then they will still move through customs. So there will still be customs consequences as well as import VAT that may be charged on transfer of the goods through customs. But this should be recoverable, one would expect. Okay, so that's the last of the questions. Dinesh, I don't know.
No, there is no question.
We have no questions for corporate tax. Okay, there's one last question for, it looks like a VAT question. So is reimbursement of expenses with related parties with UAE and Saudi subject to VAT in Oman VAT? Reimbursement of expenses with related parties with UAE. So I think what this question is getting at is, will Oman VAT consider the UAE and KSA as intra-GCC, or would it still be considered as a foreign country? At the moment, there's obviously no guidance, but in line with the other GCC countries, you would expect that Oman would treat UAE, Saudi, Bahrain as completely separate countries outside of the GCC for the time being. That will be the case until all the GCC countries recognize each other and the intra-GCC rules start to apply. So at the moment, I would treat every GCC country as a separate country. Therefore, if you're having transactions between these countries, you would have to consider the VAT consequences that would apply. Perhaps you could probably zero rate it if you're exporting things. Okay, that brings us to the end of our Q&A as well as the webinar itself. As I said, we release a weekly tax flash email every Thursday, which covers the updates during the week. And then we obviously have this Tax Matters webinar every month to go through any of the key issues as well as some interesting case studies. If you have any questions between now and the next webinar, please reach out to any one of the team. We will send these slides to you by tomorrow, along with answers to all the questions. But if you have any questions, please feel free to reach out. But other than that, thank you for dialing in, and we'll talk to you next month.
Thank you for joining our webinar.